Hello, everyone. This is Shannon Williams of D2R Taxes, where we specialize in tax planning, tax strategy, and tax preparation. So today, I want to talk to a lot of my W-2 earners. I have had a lot of clients that are W-2 earners, high income W-2 earners that are very upset because they are tired of going online. They are tired of seeing all of these business owners being able to cut their taxes down. And they too know that they feel like they are overpaying in taxes too. And so they want to know, hey, Shannon, what is out there for me as a W-2 earner that is happy with their job? I'm happy with the amount that I'm making. I like my leisure time. So I am not interested in really, starting a side hustle. I don't have the time. I don't have the interest. It's just not something that I want to do. And so that is not a problem. That is totally okay. So first of all, I do want to say that not everybody wants to be, a Amazon store owner or start a barbershop or a catering business. Not everybody wants to start a business, period, right? And so for those W-2 earners, I have come to the board with a couple of things that you can actually do. But the first thing I want to say is what are we talking about? Okay. Why am I going to suggest certain things? Because if you want to play a game, let's be clear, the tax game or tax benefit is a game that people are playing, right? It is a legal game that you can play. But if you want to play any game, you have to abide by the rules. And it is in black and white that the code is more so for somebody who owns a business, right? Because that person is creating jobs. They are putting money back into the economy, right? That person is going to get the tax benefits. And so just because we are W-2 earners and we're making great money, and we're saying, hey, we're complaining about it, that's not going to change the actual way that you're able to tap into these tax benefits. So that's very important to understand. So let's just jump right into this video, okay? So you have a W-2 earner. The first thing I think is very important is that you understand how you're getting your taxes as it is right now, okay? And the reason why you're probably either owing or not getting a large amount back, okay? First of all, let's use an example of $100,000. Let's just say you're at a W-2 job, meaning that you're not getting a 1099, you're not self-employed, you are getting paid, and you receive a W-2 at the end of the year when you go have to file your taxes. Everything is on a W-2 and not a 1099. They are taking, your insurance out, they are taking your taxes out. They are doing all of these things, and you feel like you are compliant. You let them take the correct amount of taxes out, but for some reason, you always owe, or again, you may owe a little bit or owe a lot, but you're not really getting that 15, 10, 9,000, or even 7,000 that you're seeing other people get. So I think it's very important for us to break that down and actually explain to you why. Okay. So tax brackets is the first thing that is very important to understand. As you get paid, the more you make, the more you're going to have to pay in taxes because you're going to be taxed at a higher bracket. So that means that even if you are allowing them to take out taxes out, you are still being taxed at a high bracket. So we'll use 112,000. Let's say you make 112,000. Okay, you are not being taxed at 10% or 12%. You're going to be taxed at a higher bracket, which means that you're going to start off owing at a higher amount. The second thing that works against you is the more money you make, the more certain credits that other people receive, like earned income credit, that starts to phase out and you don't get those type of credits anymore because you're not considered low income. You're making really, really good money according to the government and the IRS. So, you're not going to get those type of credits. So that's another thing that's going to hurt you. Another thing that you want to actually understand is how deductions work when you do not have a business. We're not talking about expenses, we're talking about deductions. Now, you are going to get a standard deduction regularly, meaning you don't have to do anything. They're going to give you this deduction amount, and that's typically all you're going to get. You can either take standard deduction or itemize your deductions, and I'll explain to you the difference. If you take the standard deduction, if you're single, it's 12,900. I believe, I know it's in the 12,000s, right? So 12,900. If you are married, it's going to be 25,000 and change. If you are head of household, it's going to be 19,400 or 19,900. However, it's in the 19,000s, okay? So that means that you don't have to do anything. All you have to do is file. They are going to give you that credit. Really, another way that you can change that, okay, is if you don't take the standard, you take the itemized, because the things that you have been paying for throughout the year and that you have proof of is going to be more than the standard that they give you, okay? So let's take a look at what that looks like. There is dental, there is medical, prescriptions, copays, charity, tickets and tolls, interest, taxes that you've paid. How much did you pay to get your taxes done? There are a couple of different things that you can write down and bring to your CPA or your tax preparer, and you can say, hey, this is what I should be having credit for. But let's just say you are head of household and you're supposed to get 19,000 and change, right? Or let's just keep it simple and say single. You're supposed to get 12,900. If your itemized deductions only add up to being 9,000, that's not going to help you, because they're already going to give you 12,900, right? But if your itemized deductions are totaling up to be $17,000, well, then that will move the needle just a little bit, but not enough for you to really see a difference when you're a W-2 earner making six figures, right? Those are your doctors, your lawyers, all of those type things. You might still be partner, but you're still getting a W-2, those type of things, right? So those are the people that we're talking to. Or maybe you work for the government, right? Or you have contracts or whatever it is. You work for the government. Whatever your job title is, you are making close to six figures. And so this does affect you. And so because this is the only thing that you have, okay, you're single, you have no dependents, there's nobody that you can kind of change to head of household because it is just you, you're only going to get 12,900 unless you have accumulated more than that to kind of help you. And so that becomes very frustrating when you're turning on the TV and you're hearing, oh, this business owner was able to get $80,000 of deductions, right? And it's like, okay, hey, I know I'm overpaying too. What do I need to do? What can help me? Okay, so guys, I have the answer for you, okay? And what it is real estate. That is the only other way that you're going to be able to tap into the tax code, okay? Let's be very clear. When tax code and tax benefits and all of these things were created, it wasn't designed for everybody. It's not designed for everyone to actually, receive or take advantage of. So if you're wanting to take advantage of it, you have to, again, play by the rules that they give. And so most of these benefits are going to be towards investors and business owners, true business owners. Yes, there are some deductions and some tax benefits for LLCs and your smaller businesses, but for your big corporations, there's even more. So again, not everybody wants to run a big corporation in order to get this. So the next thing that you can do is you can tap into real estate. Now, I push real estate for people that I talk to because I think it's absolutely amazing, because it's a double-ended sword. Not only are you able to go ahead and get great tax benefits from having investment properties or real estate, okay, but you're also able to build generational wealth that keeps going and going and going and going and going and going. So it kind of helps you. It helps you bring more money in while actually protecting the money that you already have, your generational wealth, your legacy, the things that you want to leave to your children, all of those things, you're still going to be able to protect it. And then also you're going to be able to go ahead and get to a point of paying 0% in taxes which means more money in your pocket, more money to then buy more real estate or invest in other things, or simply just keep the money in your house growing in a bank account. It really doesn't matter. The point is it's going to allow you to not overpay in your taxes. And even if you're paying the correct amount, it will allow you to not pay anything in taxes, right? So how many of us can think what we would be able to do with an extra $50,000, $80,000, $200,000 that we did not have to go ahead and pay to the government because we were able to get, tax plans and tax strategy going to understand how the tax code can work for us as opposed to against us, and it totally be legal. What would you be able to do with that? Could you sleep better at night? Right? Or could you do more things in your family? Could you open up that business that you want to open up? Right? And so that is what we are talking about today. One of the tax benefits when you are in this real estate game is going to be depreciation. And so I'm excited to bring that to you today. But before we do that, let's go ahead and talk about why you would actually do this. Okay. So if you are high net worth and W-2 income, you know that you are overpaying in taxes. You are tired of overpaying in taxes. You are tired of watching other people get all these deductions. But again, you're happy with your business or the W-2 job that you have, and you're totally not interested in actually leaving your job or starting anything new. So you know all of this and you're irritated. And another thing that irritates you is that you know that you have lack of tax knowledge, right? So what happens is if that is you, this is the video for you. So you are paying high in tax brackets, you have no deductions. There are certain credits that start to phase out, lack of tax knowledge, and you typically get a raise every year. All of those things work against you. However, it's actually really good for your personal life, right? So what are we saying? Are we saying that because you're making so much money, now it's to the point to where you need to stop so you don't pay in taxes? No, absolutely not. Go ahead and continue to get those raises, right? Go ahead and continue to do better every year and scale every year if that's what you want to do. But if you don't want to go the route of actually owning another company, okay, the next best thing to do is real estate. And how does that help you? What is the benefit of real estate? Real estate not only, again, is going to get you that tax benefit to where you can pay 0% in taxes, but it's also going to help you build your generational wealth. It is going to help you be able to go forward and maybe refinance so that you can fund other projects. You can't do that when you're renting. So there are some benefits in real estate besides the taxes that are really, 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 really important for people to understand. Okay. When you're doing real estate, it's a constant bank. You can use that to fund other projects, right? You can refinance and not pay any taxes and then still go fund other projects. So what does that look like? You're making $100,000, okay? Now, so you probably, or let's just say you're making 200,000, so you can afford a down payment to go ahead and do some real estate. And when you're doing the real estate, you are an investor, okay? You're either long-term or short-term investor. Long-term meaning that you have maybe a 12-month lease in place, and short-term, something like Airbnb. So if you're going to do a long-term lease, then there are certain things that you need to qualify to do this, and we'll talk about that in the next video. But essentially, you need to be a real estate professional, which one of the stipulations is you have to do at least 750 hours in your property or doing real estate in the real estate industry. There are some other, like myself, I am a realtor, okay? So it would be easy for me to show that I am a real estate professional and be able to tap into some of these different things, okay? But if you're not going to be able to do that, maybe again, you're a lawyer, so you don't have the time to do 750 hours. You're not married, so you can't have your wife or your husband do 750 hours and work together on this to where you keep your job and your spouse is actually tapping into the real estate professional route, right? That's not a factor because you are single. The next thing that you can do is you can do short-term renting. You can do Airbnb. And so what that does is it allows you to skip the 750 hours, then you don't have to do that. And it allows you to tap into certain tax benefits. One of the tax benefits is going to be depreciation. And I'm very happy to explain to you what depreciation is and how it works. So normally when we hear depreciation, or when I ask my clients, what do you think of when you hear depreciation? Typically they talk about their jewelry or their cars, or the fact that when you purchase something, it is depreciating. So if you bought it back, a day later, it still wouldn't be the same amount because it depreciated in value. Same thing is going to be for when you are purchasing property. So again, remember, I just told you that the tax code works best for investors. So one of the incentives that they're going to give you is to depreciate your home. That means that they're going to give you, as long as it still has useful life, they're going to give you a certain amount for this property that you can depreciate for a certain amount of years. Now, for a residential home, it is 27 and a half years. For commercial, I think it's like 39 years, okay? So what you do is you take the value of the property and you divide it by 27 and a half years, okay? So what does that look like? And it's also very important to understand that you cannot do that with the whole amount. So the best thing to do, and what best practice is to look at your paperwork from your closing. It's going to tell you how much of that let's say you spent 720,000 in purchasing a property, okay? It's going to tell you that maybe 100,000 was for the land and 620,000 was really for the building, the actual building, right? And so the 100,000 that the value of the land is, you cannot run this play on. You cannot depreciate that 100,000. You can only depreciate the actual structure, the building. So I am an artist too. I forgot to tell you guys that. So I actually have a drawing that I want to show you guys that may help. Okay, so this is my masterpiece here. Okay, so this is the structure. Let's just pretend that we've got some grass here. This is my grass. Okay, so this is the land here. Okay, this is what is worth 100,000. However, the structure is worth 620,000. So this is what you can depreciate. You can only depreciate this, okay? So again, time frame is 27 and a half years for residential and 39 years, I was right, for commercial, okay? So if you take 620,000, okay, and you go ahead and divide that by 27 and a half years, that is going to come out to be $22,545. That is an additional deduction that you're going to get for the next 27 and a half years that you own this property. Okay, so that's 22 and a half. So when you are, and again, let's remember, we're talking about W-2 earners that really don't have too many options. They're making a lot of money. You're trying to figure out what it is that you can do. Here is an option that is not only going to put money into your pocket, but it is also going to give you a high ticket deduction, or that you can add to the 12,000 that they're already going to give you. So what does that look like? That's now $36,000 that you can deduct from that $100,000 number. That's going to bring you down, bring your tax brackets down to a certain point. And then again, other factors, other things factor into your final number, but now you're going to see that needle move. But here's what's really cool, guys. If you haven't caught on yet, here's what's really cool about this whole situation. If you are making that type of money, chances are you probably understand that you're building into your generational wealth. When you purchase this rental home here, you're not even paying for it. Even if you pay a down payment, If you're renting it out long term or short term, you're probably going to make that back quickly. So now you have this asset that essentially is really for free in the manner that you're not paying for it because you have a tenant in there paying for it, or you're running Airbnb or short-term rental. Either way, you're not paying out of pocket for it. That's the important part. You are not paying out of pocket for it, but you get all of these perks. You now are able to write off $22,000. That in itself, if that is what you paid around for down payment, is now you're getting it right back. But now you still have the extra advantage of doing this next year and the year after that and the year after that and the year after that and the year after that. That means that even if you're continuously getting a raise at this W-2 job that you're receiving, right? It doesn't matter because you're still going to start off with this right here, this $22,000 deduction that's going to give you a great starting point of having this high ticket, what I call high ticket deduction. Okay. So that's very important to understand. Another thing that you understand is forget about the taxes. Now you have this asset that you can use as collateral for other loans. You can use the money that your tenants are paying into this. Let's just say, your value of the property is going up. Okay. And so now this home was worth 720, but it's 3 years later, the market is booming and now it's worth $1 million. You can actually pull out that difference tax-free money, go buy more portfolios that will help you even more. Or you don't even have to use that to buy more real estate. You can use it to send your kids to college and make sure you're giving them a start without having crazy student loans. You can use it if your daughter or son says, hey, I want to start this this new fashion line. You can say, okay, you know what? I'm going to refinance this property. I'm going to pull out money from the equity and I'm going to help you fund your dreams. You can go back and say, you know what? When I retire, I really wanted to buy this home, vacation home in this foreign place, or overseas. You're able to do whatever it is that you want to do with it. So you've set yourself up to using OPM, right? It's really yours, but somebody else is actually paying into this property. You're not paying for it, but you're getting all of the benefits of having a property. You can also leave this property to your family when you pass, right? You're setting them up for generational wealth as well. This is how the 1% do it. The 1% or the wealthy that know that they're making, millions and billions of dollars, they run straight to real estate and have a huge real estate portfolio because they understand that not only is this adding to their assets and their net worth, but it's also safeguarding and helping them not to pay taxes on what they already are doing or where they project themselves to be in future years. So that is why I call this a double-ended sword. And even if you didn't get that, I have two major points that are going to blow your mind. Okay. So now let's just say you're like, you know what? I normally have to pay 300,000 in taxes. I'm not really just owing 100,000 or making 100,000. I really typically have to pay or normally owe 200,000, right? So you're like 22,000 is really not enough for me, Shannon, to really be considering doing real estate. That's what you're saying, right? So, okay, let's talk about something else. What if I told you that you were able to accelerate your depreciation? Oh my God, Shannon, what is that? What is that? Okay, accelerating your depreciation means that certain parts of the property you're able to not take over the course of the 27 and a half years. You can say, I don't want to do that. I want to accelerate the depreciation. I want to depreciate all of it now this year. So if I know that I have a bill of, let's say, 200,000, because I know approximately how much I'm going to make, and I know I'm probably going to owe the taxes or the government at around 200,000, and I buy this property, I accelerate the depreciation on this property, right? then what does that mean? That means that now I can't do the whole 620,000, okay? Because you have to do a report on this whole thing. They're going to come in, they're going to look at things in your property, they're going to see what items in the property you can accelerate. That's just the way it is. Not everything in this structure is something that you can use to accelerate the depreciation. So let's just say we are conservative and we say that you're going to write off or accelerate 35%. Okay. And that's a conservative number. 35% of this 620 means that you now have a deduction of $217,000. That means that that would cover all of the money that you actually owe the government, right? And this is an asset that you gave yourself that you are not even paying into because there's a tenant in it. You're not even coming out of pocket with it. You're getting all of the benefits of actually having this being an investor, right? You're getting all of the benefits as far as being able to refinance, having an asset, adding to all of your network, and then on top of that, you mean to tell me that I can write off 217,000? Now, really, the formula calls for 40%. But just, so that means that's 248,000. But just to be conservative, I said 35%. 35%. That gives you a legit deduction of $217,000. Now, if you had a bill that was $217,000 and we came along and we said this, and then let's just say that you're still receiving money from this investment property, right? So you're still receiving taxable income, right? So really, if we did 40%, that's still going to cover $30,000 that you might be receiving of taxable income, right? So 248,000 will leave you at 0% of paying in taxes. So now you have an additional 200,000 plus that you can use to either go buy more property or not even just go buy more property, do whatever it is you want to do with it because you expected to pay it to the government. You set yourself up that you could pay it to the government, but now because you have learned about this accelerated depreciation, now you don't have to pay it. You can do whatever it is you want to do with it. That is how the 1% live and the wealthy live. They figure out, hey, you know what? I think I'm going to owe this amount. Let me fall back on my real estate portfolio. If you guys think about it, anyone that is financially stable, not even just stable, but rich, okay, wealthy is way bigger than rich. All of these people that are wealthy, they typically have an extensive real estate portfolio. Even your celebrities, if you watch them on their interviews and all of these things, what happens is you always hear them say when they start making it, oh yeah, I'm getting into real estate now. It is because it is a way for them to build generational wealth to fall back on just in case that music career doesn't go too far, or just in case those businesses may not run for the rest of their lives. They're setting themselves up and their children's 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 children to be okay and more than okay to change their lives with real estate to fall back on. That is, something that is concrete. And not only that, guys, I know you know this step, which is very important. Most people understand the concept of the more you make, and this is whether you're W-2, 1099, self-employed, it doesn't matter. All of these things, right? The more you make, the more you're going to pay back. So what do most people do that don't understand tax planning, tax strategy? You're still in the realm of thinking like, okay, well, all I'm going to do is file my taxes from January to April, right? So you don't really understand the whole tax game, okay? So you understand that the more you make, the more you're going to owe. So if the more I make, the more I'm going to owe, I'm just going to run up all of these expenses so that I can bring down my income. And so now I don't owe as much as the government says that I should owe because I did not make that amount of money. Now, that's not always going to help you in the long run. That is right now gratification. That is not thinking of generational wealth. That is not thinking of this is where I am right now, but in 10 years, this is where I want to be. Because what's going to happen is if you have a business and you are saying that your business made close to nothing, then when you get to a point of trying to get investors and using OPM and banks to actually give you money, they're going to see that your business made no money, and so they will not give you any money. So that is not going to help you whatsoever. It's going to give you a little check right now. But as far as scaling your business and not using your own money for the life of your business, that will not help you. Showing that your business made no money, no investor is going to say, you know what, you only made $2,000 or your business took a loss, so I'm going to give you $100,000. No, it doesn't work that way. Even if you're not in the whole business thing, you're a W-2 earner, maybe in the next couple of years, you see yourself buying your first home, right? You might see yourself buying your first home and you see your family Thanksgiving meeting there. You see all of these things, but yet you go sit down with somebody to say, hey, Navy Federal, will you give me a loan to purchase my home? They're going to ask you for the last 2 years of taxes. They're going to see that you had this Schedule C that took down all of your W-2 income so that you could get this check of maybe $7,000. But with doing that, you said that you really didn't make any money. You only made $20,000. They're going to deny you because if you're telling the government that you made no money, so you shouldn't have to pay these taxes, you're actually telling these investors and the banks that you're trying to get these loans from the same thing. Hey, I made no money. So if you made no money, how are you going to pay back these loans? They're going to deny you, right? So now I want you to keep that in mind. Here is another thing with accelerated depreciation. It is added back. It is added back. So when you go sit down with this banker, if accelerate, this is how it differs from having a Schedule C with a bunch of deductions. If, let's just say for the sake of explaining, you had deductions of $40,000 and you only made, or let's just say you owed 300,000 and you claimed that you had $280,000 of expenses, so you really only profited 20,000. When you go sit down, that is what the bank is going to see. They're going to say, okay, you only made $20,000. We can't give you anything. Have a great day, sir. And they're going to walk you right out. Okay. All right. But here's where accelerated depreciation is so awesome because they know that it is depreciation. It's not an actual expense. It is added back in. So if you claim the same thing, right? Let's just say you owed 300,000 and the property that you purchased at, 800,000 or whatever the number is, it allowed you to accelerated to depreciate a total amount of, let's say, $280,000. So technically, whereby you're only seeing 20,000 profit. Okay, when you go sit down with the banks, they're going to add back in that 280. They're going to still see that your business is still making money because they're going to bring that right back up to the 300,000. Isn't that crazy? Isn't that amazing? That is the type of benefits that you have when you are an investor, or, well, in this scenario, we're talking about real estate. So when you're an investor. So guys, I hope that this video actually helped you. I hope you guys see the importance of, investment properties. There are things that we can talk about on how you can run the investment property if it's not something that you really want to do. I don't want you to think about all of that right now. If it's worth having a conversation about so that we can ease your mind into certain things, then I want to make sure that you have the information to contact our office, and we are happy to have a quick conversation with you. If you feel like real estate is something that you have questions about, you're interested, or you're just ready to go and start looking for investment properties. Again, this is something that the wealthy use all the time. This is what they run to because there is so many different tax benefits from running this one thing that is going to help you and for years and years and years to come. If it gets to a point to where you've had these properties and now the depreciation is running out and you're like, hey, what am I going to do now? I'm going to, oh no, there's still another play that you can do. You can 1031 exchange it, sell that property, purchase another property, and start all over again. So this is a never ending game. It's a never ending game. And the sooner you guys put yourself in position to actually play this game is the sooner that you guys will be able to use your tax time as a tool for generational wealth and not just instant gratification. Guys, I am Shannon Williams of D2R Taxes. I am your strategist and your realtor. Make sure you guys tap in, hit the notification. Have a great day. Bye.